theoretical or reasons behind, because there are so many indicators. Maybe each of them has a link. So far at the moment, maybe it's difficult to understand. And on the other hand, how to valuation a company or a corporate about their financial situation.
Sure. Okay, thank you very much for sharing. Let me just, I've done this on webinar 1, but let me just briefly give a broad introduction of what we'll be covering in this seminar again. So, simply put, we will be looking at equity as well as debt in this entire 7 webinar series. The first 4 lessons will be on equity, and the last 2 lessons will be on debt capital structure. Now, this is an EMBA class, and you're all senior leaders in Gobain. So the difference between EMBA and an MBA is, simply put, the MBA, you will learn more of the tools. Okay, so for example, like you will learn how to construct a DCF for MBA class. Another example, maybe using marketing, is MBA class, you will learn how to conduct interviews and surveys, so forth and so on. But in EMBA class, given that you are senior executives, what we will focus on is how to interpret and analyze those results. What do I do with the results? So simply put, you're in a position where you snap your fingers and a DCF or marketing survey is in front of you. Okay, someone else actually does it. And your job here is really to interpret those results. What do with these results going forward? And that's really how we have structured the 7 webinar courses over the next 7 Mondays. Okay, so just a brief overview. Now, just to address M&A specifically. Now, M&A is a key topic. We will not be addressing M&A during this corporate finance seminar. It's just too much to cover. M&A is a very specialized topic. I do conduct M&A courses as well, but so again, happy to take M&A questions, specific M&A questions, say before class or after class, or things like that. But during the class itself, we will not be focusing on M&A. All right. Okay, so hopefully with that, we are going to kick off today's lessons on capital market valuation. So let me just share my screen. Okay. So just a brief background myself, which I've done on day 1. Now, okay. So let me just give you this slide, which shows a typical approach to evaluation. This slide is the most important slide in the entire slide deck. Okay, this slide is really what we are, the first 4 lessons we'll be talking about. Now, what is this slide exactly? Simply put, this is what you call a football field chart. Now, why is it called a football field chart? Well, it's not exactly, they're not talking about Asian soccer, not the ball that we kick, but this is more like American football. So, for those of you who know American football, it's like how many yards do you cover with each run, before you hit the touchdown. So basically the football field chart, if I mean American version. Now, if you see in this dotted gray box here, okay, now this dotted gray box shows you the different valuation methods that
I'm sorry.
Yeah.
I'm sorry, Rosalind. Maybe we are viewing different slides. So what we see is your brief introduction. No.
Oh, do you see the heading is called typical approach to company valuation?
No.
Okay.
No, we only see our profile.
Sure. Let me try to reshare again. Okay, do you see the typical approach to company valuation?
Yes.
Okay, good.
Yes.
Thank you for letting me know. Appreciate it. Okay, so in this dotted box here, the analyst has different valuation methods. So for example, this analyst has used trading comparables, precedent transactions, DCF, and breakup value analysis. Now, in this course, we'll be looking at the first three on trading comparables, precedent transactions, and DCF more closely in the next few slides. We will not be talking about breakup value analysis here. Now, simply put, in trading comparables, in this example here, the analyst is looking at a 2021 expected EBITDA multiple and a 2021 PE multiple. Not to worry again, we'll be covering more on what these mean in a later section. But for now, what I want to highlight is two things. First, we are always looking, whenever we talk about valuations, we're always talking about the future. Okay? Whatever has happened to us in the last 10 months, or in this case, 11 months, has no financial benefit because it's already publicly known. So simply put, what we are keen on is what goes on the 12 months from today. So, which is why we need 2021 expected EBITDA multiple. 2020 is no longer applicable. Now, there's a low to a high range, depending on the multiples we use, and we'll talk more on this when we hit the second section, and a low to a high range for the PE multiple.
I'm sorry.
Hi.
So are you sharing slides or Excel?
This is a PowerPoint slide on screen.
Okay. Okay.
Okay. Now, the next valuation method here on the screen, if you follow my mouse, will be the precedent.
Should make bigger?
This is actually the biggest I can make. Yeah. Yeah, but you also have the same slides in your slide deck. So if you look at the zip file, which you all have, there is a PDF file called Capital Markets Valuation. So I'm really using the same slides there. Okay. So for precedent transactions, simply put, these are actual transactions. They could be M&A, or they could be private placement or block trades. So simply put, this analyst has used LTM, which is known as last 12 months. Okay, last 12 months sales multiple and last 12 months EBITDA multiple. Again, there's a low to a high range, low to a high range. And we'll talk more in much more detail on section 2 when we talk about this section. Now, the valuation method this analyst has used is DCF, or discounted cash flow. Discounted cash flow is by far the most important method, and we'll be spending a lot of time on that next Monday. Okay, next Monday. So again, there's a management case, which is a low to high kind of range. Now, in this DCF example, because it's for M&A, there's synergies as well as tax benefits. So again, this analysis is just layered on the DCF for synergies, including synergies, as well as tax benefits. Likewise, low to high, low to high. And lastly, there's a breakup value analysis. So simply put, if we were to, say Gobain, for example, has a lot of different divisions, building and materials, etc., etc. If we were to break up Gobain and sell off each segment of the business, what will it be worth? Now, this is a separate analysis altogether. We will not be covering breakup value analysis, but in this case, the analyst has got it at, say, low to high kind of value. Now that this analyst has got many lines here, as you can see, what you then need to do is to find what is a fair value range, which is given by the shaded area. Now, valuation is more of an art rather than a science. So, if this analyst has looked at, say, a $22 to $24 fair value range, if you think that it's slightly to the left, or some of you think it's slightly to the right, all of you are actually correct. It is subjective. But there are a few rules to follow. First of all, this shaded area here, it must be fairly small. So if you tell me the fair value of this stock, let's just call it Gobain, for example, is anywhere from like $17 to $27. You know, the whole range, the whole chart will be shaded. Then it is of limited value, right? Too wide a range, might as well not do the analysis at all. I might just tell you the fair value of Gobain stocks from $1 to $99. Okay, might as well not do anything, right? Much too wide. So it's got to be a fairly narrow range. Number two, it's got to try to cut through as many data points as possible. Okay, so you try to cut through as many data points as possible. Now notice I did not say you have to cut through all data points. For example, in this simple analysis, this analyst did not cut through the breakup value. It also did not cut through this EBITDA number. So just to be clear, you try to cut through as many data points as possible. And this is important, you must cut through the DCF. Okay, so while you may not need to cut through all the data points, you must cut through as many data points as possible, and you must cut through a DCF because it's the most important. So these are some of the general rules to follow when constructing this football field chart. At one glance, your management will know exactly what valuation methods you have used, okay, and what is your fair value range for this business. Okay, everything in one snapshot. Below this dotted line box here, you can also include some information such as what is my current price, what is my stock trading history. So in here you have a 30-day moving average, as well as your 52-week low and high kind of range, just to give some idea of where you think the fair value of your stock is versus where your stock is now. So one page kind of tells your investment committee everything. Now, let's come to this slide, which shows that your price and your value, okay, these are two different concepts. And price and value may not always converge, and that's why it gives rise to a gap. Now, let's talk about each of them very carefully first. What is value? Okay, now the value is what you call intrinsic value, or what you think the company is worth. Okay, what do you think the company is worth? Now, for purposes of for this discussion, I'm just going to use the company as Gobain. Okay, so simply put, is what you as an analyst think Gobain is worth. And there are certain tools you can use here, which is DCF, as well as book value based approaches. Okay, now we're going to talk more about this a lot in DCF in much more detail next Monday, so not to worry. Now, what are these drivers of the intrinsic analysis? So what drives value exactly in Gobain? So there's really three key points here: cash flow from existing assets, growth in cash flows, as well as quality of growth. All right. Now, in short, what this distills down to, class, is key takeaway number one. And again, everyone, please mouth the words wherever you are. What is key takeaway number one, class? What is core valuation principle? So core valuation principle is increase cash flow, increase asset value. Okay, so please repeat with me every time I say what are my three key takeaways, because I'll be going through them a lot. So simply put, increase cash flow, increase asset value. What drives the increase in cash flow is really these three things here, right? What is my cash flow for my existing assets? What is the growth in cash flows? And what is the quality of the growth? Now, let me jump to the price first. So the market price. So, very often you'll be wondering the question, how does the market price Gobain, or how is it trading in the market? So there are tools for market pricing. For example, multiples as well as comparables. And this will be looking more of the following Monday. So this will be webinar sessions number 4. And they also will be looking at charts or technical indicators, right? So all these uses market pricing data. We will not be talking about technical analysis here. We'll be talking more about fundamental analysis, which is intrinsic valuation. But again, if anyone has any interest in technical analysis or technical indicators, happy to take those questions before or after class. Now, what really drives the market price here for Saint-Gobain, for example? Now, the key drivers here will be what is the expected demand and supply for the next 12 months. Now, let me be very clear on this. The market price of Saint-Gobain, whatever is trading in the market right now, does not reflect Saint-Gobain's current position. Okay? It does not reflect Saint-Gobain's current position. What it reflects is what the market expects for demand and supply for Saint-Gobain in the next 12 months. Now, it is very difficult to understand this, and very often people are wondering, as you know, 2020 is the year of the COVID, right? And simply put, the stock market is supposed to be a reflection of the economic growth of the country. Stock market is supposed to be a reflection of the economic growth of the country. Now, let me be clear. The stock market is not a reflection of the current economic growth of the country. The stock market reflects what is the economic growth of the country in the next 12 months. So it's forward-looking. It is not current. All right. I'll re-emphasize this many times because you will. Just a hint. You will revisit this in your Snap Inc. IPO case. Now,
Professor.
Yeah, go ahead.
Is there any reason for this 12 months time period? Why not, for example, 6 months or 2 years?
Well, in general, it's a forward-looking for the next 12 months. That's the usual way the analyst prices it, because you have visibility for at least the next 12 months. Of course, there are always questions about, is there more? Are we pricing in more than 12 months, etc.? And this usually I'll answer when we come to the gap. Okay, the gap where we talk about time horizon, short term and long term. But typically, the stock market prices in what you call the economic growth for the next 12 months. Okay. Now, this is also distorted. Now, just to be clear, it will be easy if you say, okay, the price is accurate of demand and supply. But unfortunately, as you know, this is also distorted in part by market sentiment as well as momentum, and also marked by market rumors. So here's the problem. That's why the value or intrinsic value and the price do not match. And very often they don't actually match, which gives rise to this gap, this word gap here. Okay, now you can call it the gap, or you can call it the opportunity. It's really, how you look at it, glass half empty or glass half full. But let's talk about what is this gap here first. So how do we explain the gap? So the first is behavioral finance. So behavioral finance simply means this is non-financial indicators. Remember, we are all human beings. So we look upon, investment as two things. One is financial indicators, which we are doing, like DCF, etc. But remember, there's also non-financial indicators in that, such as sustainability reporting, okay? And another example would be herd mentality. So what is herd mentality? Herd mentality, just to use millennial speak, it's called FOMO, F-O-M-O. So for those of you who understand, FOMO means fear of missing out. If everyone buys, let's just buy. I don't really care what I buy. So again, herd mentality, fear of missing out. These are examples of what gives rise to the gap. Now, let's crystallize this a little bit further. What are some of the drivers of the gap? So there's information. Again, certain groups of people may have more information than the rest. And added to this, there's also the case in today's age, there's also the case of misinformation or fake news, right? So again, rather than just real information, people may spread fake news, and you may have, again, market rumors or market sentiment as well. Again, all part of the game of investment, right? All fair game. It's whether or not you know how to discern between real information or fake information. Of course, there's liquidity. Okay, so liquidity, has a lot of impact on the stock market these days. Corporate governance is also obviously a key driver. Now, corporate governance in the sense of how much information do you disclose, and do you disclose the right information? So what it means is that by disclosing more information does not actually mean that you are more transparent. Okay, what makes you more transparent is to disclose the right information. And we're not covering sustainability reporting in this seminar, but to be, just to give you a quick flavor, sustainability reporting relates to non-financial reporting, if I may. If I may, it's an added layer of risk management. And by having non-financial information, it kind of increases the amount of information, or rather the disclosure, the quality of disclosure. Because as an analyst, you're then able to say, look, this is the finance numbers, what you're telling me. These are the non-financial numbers, what you're telling me. Do they make sense? Okay? Or you can say, hang on, they don't really quite make sense. So the quality of information matters, and that the quality of disclosure is what drives transparency, not just giving stakeholders more and more, if I may, useless information. Just to give you a simple picture, just to reinforce this concept, for those of you who drink sugarcane juice, right? You know what they do? They, old style machines, right? They have the two big rollers, and then you put the sugarcane through the rollers, and you squeeze out some juice. The store owner then picks the sugarcane, folds it, and then rolls it through the roller again and again and again, and more juice comes out. By putting the same sugarcane across the roller many times, there's only so much juice you're going to extract. Unless you think of new ways to extract this juice, otherwise that you're going to hit a ceiling at some point in time. And so that's the whole idea of sustainability reporting, non-financial reporting. And the last driver of the gap will be on expectations. There are differences in expectations, short-term versus long-term. Again, as you can imagine, in the market, there are many different kind of players. Some are short-term traders, some are long-term investors. Again, they're all in the market at any point in time. So again, the short-term versus long-term expectations can also be one of the drivers of the gap. Now, not to worry, I will touch upon this slide again when we talk about the 4 cornerstones of corporate finance, which we will talk very, very soon. But before we get there, I'm going to talk a little bit about the WACC first, weighted average cost of capital. So if we think about the balance sheet, okay, so in the typical balance sheet, what do we have on the left-hand side? We have assets, right? And on the right-hand side, what do we have there? We have liabilities and equity. Now, the balance sheet is constructed as such because, simply put, you can only buy assets using either debt or equity. One more time, you can only buy assets on the left-hand side using the right-hand side, which is only debt or equity, or combination of the both. So not surprisingly, there is a cost to the capital of the company. And what is the cost? Simply put, is the blended average of the after-tax cost of debt and the cost of equity.
Professor,
yep.
I'm afraid we are not seeing the same slide with you. We are seeing the same slide around maybe last 20 minutes.
Oh, okay. Let me try and share this again. Sorry. Come on.
And Professor, today you also record the class, yeah?
Yes,
in case you
recording.
want to review again, yeah?
I'm recording the class. Yes.
Okay.
Let me just share my. Okay, let's try this one. Are you looking at the weighted average cost of capital slide?
Yes.
Okay. Well, let me know. Okay, let's do it this way first, and let me know if you hit technical prompts again. So as I was saying, you can only finance the company using either the debt or equity. Now, what is the formula for the WACC? Simply put, it's the percentage that you use of debt multiplied by the after-tax cost of debt. So what this means is your debt divided by your debt plus equity, because this is the total amount of capital that you have, multiplied by the after-tax, that's 1 minus T, after-tax cost of debt. Now, the debt, as you know, because debt is interest, interest is tax deductible, so there is the after-tax cost of debt. There's no such thing because equity is not tax deductible. Now for equity, the formula for the equity is the percentage of equity they use, which is equity divided by debt plus equity, multiplied by the cost of equity. So when we add these two together, you have your percentage of debt multiplied by your after-tax cost of debt, add your percentage of equity multiplied by your cost of equity. So the blended average of the cost of debt and the cost of equity gives you what is known as your WACC, or the weighted average cost of capital. Now, let's go a little bit more deeply into what is the cost of debt and the cost of equity. Now, the cost of debt is quite simple. All of us in this room will be able to agree on what is the cost of debt for Gobain. Simply put, there's only two ways to get the cost of debt. And we're talking about a market cost of debt for Gobain. Either you call the bank or you call the rating agencies. Okay, you call the bank or you call the rating agencies to ask them, how much would you lend to Gobain? Okay, so very often we will all agree on the cost of debt. Now, in Singapore's context, the general company in Singapore, general listed company in Singapore, the cost of debt is approximately around 3 to 4% at the current moment. And it is declining as we speak because, as you can imagine, interest rates are going down. So whenever they refinance, the cost of debt declines as well. But in general, right now, 3 to 4% as a gauge. Now, very often they ask, there's a saying, right? Debt is cheap, equity is expensive. Debt is cheap, equity is expensive. Let me just take the class through a very simple case study. And I would like to ask the class comments, on this simple case study. So just listen as I describe the case study to you. As you know, I serve as a board director on a few listed companies here in Singapore. Now, let's just say one of these listed companies does all its business in China. Okay, so 100% just in China. This company's founder, CEO, chairman, just one person, right? Is 70 years old and he owns 70% of the shares of the company. Okay. Now, this company is this company is looking to expand. So it needs 100 million RMB, okay? RMB 100 million in order to expand. So the CEO / chairman is just wondering, okay, look, how do I finance this? And very simply put, it's either debt or equity, right? Either new debt or new equity. This company does not have any loans outstanding. So this is the first time, if we take a loan, this is the first time we will ask money from the banks. Let's just assume that the cost of borrowing or the cost of debt in China is 10%. So the cost of debt is 10%, just to make it simple for calculations, right? So let's just say we take 100 million RMB loan, interest or cost of debt 10%, right? So we need to pay 10 million RMB interest every year. That is cash. If we don't pay 10 million RMB interest or cash interest every year, the banks will foreclose our company, take away our assets, and make us bankrupt. Agree? Now, the second way, of course, is to sell some equity. So through a private placement. So you can sell some equity. Now, remember, let's just say this company, because they're growing very fast, they have never paid a dividend before. And if you like, I can also say I will not be paying a dividend for the next 2 years because I'm growing very fast. So I need to conserve cash, right? So, yes, if I sell some shares, there will be dilution. So earlier, I did mention this controlling shareholder owns 70% of the business. After selling out some shares, he will own 65%. True, there's some dilution, but effectively, he's still the majority shareholder of the business, right? So with 65%. So I've done that dilution calculation for you. But here's the thing. The chairman/CEO is telling me, look, Roy, I'm not paying a dividend for the next 2 years. Okay, so dividend yield is 0. But look, and if I don't pay a dividend, nothing happens to me, right? I mean, the shareholders don't actually sue you for bankruptcy if you don't pay a dividend. Nothing happens. So let me just get this straight. Earlier you talked about debt is cheap, equity is expensive. But here, the cost of debt is 10%, but the cost of equity is 0, right? I'm not paying any dividend. So I don't quite understand, Roy, when you say debt is cheap, equity is expensive. Can you explain? So class, any comments from the class? How do you explain this conundrum to the CEO/chairman?
Yeah, I can have some comments.
Please.
Well, when you saying that you are not paying some dividends, it's not because that well, actually in my opinion the cash flow didn't go like that. Actually, is that you agree to use this dividend to reinvest in the companies. So well, it's actually you pay the dividends and then we took it back into the investments. So that's one thing. And then the other things is that given the situation that they are growing very fast, and it should be have no problem to generate enough cash to pay back the interest. And in this case, if they loan from the bank, the return in investment should be more interesting.
Okay, thank you. Any other comments from the class? Okay, let's take a look at the Excel. Can everyone see the Excel on screen?
Yeah.
Okay, that's very good. Let's continue with this method. Okay, so I think that was exactly right. Let me try and crystallize the answer in a little bit more detail. So simply put, cost of debt must always be less than the cost of equity. All right, this is a golden rule. This is Corporate Finance 101, and this is absolutely correct. Now, simply put, Earlier we mentioned cost of debt in that simple case study was 10%. Okay. Now, so cost of equity, simply put, if this statement is going to be correct, we know that the cost of equity must be more than 10%, right? But in the case study, I've alluded it to be seem like 0. So what's going on here? So class, repeat with me, what is key takeaway number 2? Key takeaway number 2 is, it's all here, total returns equals dividend yield plus capital gain or loss. All right? So simply put, cost of equity is dividend yield plus capital gain or loss. Okay? So as we put it here, the dividend yield here is 0. I will not be paying any dividends for the next 2 years. And as you correctly put it, the cash flows will be reinvested in the business to act out a capital gain. Now, what is this capital gain column here? It will be more than 10%, as I mentioned. Simply put, if investors do not believe that they will earn a more than 10% gain on your shares, then nobody will be buying that private placement. Okay? Investors, your shareholders, will look for gains in either dividend yield or capital gain. It's a combination of these two. If your dividend yield is 0, then yes, you better give me more than 10% here in capital gain. Because, again, when I add two together, it's going to be more than the cost of debt, right? So simply put, if investors do not believe they will earn more than a 10% return in terms of capital gain, nobody will be buying our shares. All right? So let me go back to the slides on this page. Can everyone see the cost of equity?
Yes.
Okay, good. Now seems like everything's working a bit better now. Okay, so the cost of equity. Now the misconception really occurs because financial managers only think of the cost of equity as the dividend yield and conclude that equity is sometimes cheaper than debt. But they forget that investors will demand compensation through alternative means. In this case, a capital gain. So simply put, if a combination of dividend and capital gain is not compensating investors for the time and risk, they will stop supplying the firm with equity capital in the future. Now, so the question to ask, for example, when determining what is Saint-Gobain's cost of capital, okay, what is Saint-Gobain's cost of capital, is to ask your top 20 shareholders, what is the minimum expected return that they expected when you invest in Saint-Gobain? Okay, what is the minimum expected return you expected when you invest in Saint-Gobain? Now, if you look through your top 20 shareholder list, you might find that there will be some hedge funds in there, there will be some insurance funds, and there will be some individuals. Simply put, they ask for a high return. The insurance funds will ask for a low return, and the individuals will ask as high as possible. So simply put, there will be always, and you know your shareholder mix will always be changing, right? But scientifically, what the Nobel Prize has distilled this question down to is really the CAPM, or the Capital Asset Pricing Model. Now, what is this CAPM all about? It is a more scientific way that uses the market price to kind of ask this question: what is the minimum expected return which will make me invest in the equity of the company? As you can imagine, you ask 20 shareholders, they will say as high as possible. That'd be good. But this is what the market, or rather a broad range of shareholders, are actually saying. This is the CAPM. So the cost of equity here is equal to the risk-free rate plus beta multiplied by market risk premium. Now, let me go through each item. So the cost of equity, that's what we need to find. That's the output. is equal to the risk-free rate. Now, how do we get the risk-free rate? We typically take the 10-year bond, the 10-year sovereign bond of your country. So, for example, if you are investing in Thailand, use the 10-year sovereign bond of Thailand. If you're investing in Singapore, use the 10-year SGD bond. If you're investing in the US, 10-year US dollar bond. And likewise, if you're investing in Saint-Gobain, use a 10-year French bond or something, or Euro bond, okay? Plus the beta. Now, the beta is simply put a measure of systemic co-movement of the overall stock market. It's like correlation. Now, how do you get the beta? Is you just ask Yahoo Finance or Google Finance, just ask them, what is the beta for Saint-Gobain? And they will give you an answer. Simply put, they will perform the regression analysis of Saint-Gobain stock against the stock market. Sounds complicated, but all you need to ask is Google or Yahoo, tell me what is the beta for Saint-Gobain. Now, the last part here is the market risk premium. The market risk premium is the expected return on the overall stock market in excess of the risk-free rate. This item here, unfortunately, is a bit subjective. Okay? All of us in this room may not agree on one single number. In short, the question is asking, how much risk do you think it is to invest in, for Saint-Gobain, for example, it will be France? Or how risky is it to invest in Vietnam or Myanmar? So, suffice to say, each of us has very subjective views. If you are living in Vietnam, for example, you say, Vietnam, very low risk. I'm here all the time, every day. Okay? But if you are, say, if you are looking at it from US, etc., you'll be like, oh my God, so much red flags, a lot, very high risk. So again, very subjective, you can imagine, right? So this part here, which is the market risk premium, it is subjective. You have different values. Now, how do we get that? If you are Saint-Gobain, I believe you might have in-house research. So the easiest way is just ask Saint-Gobain's in-house research, tell me the number to use for each individual country. That solves the problem. If you don't have the luxury of in-house research, then you might use broker research. Okay, broker research like who? Goldman Sachs, Morgan Stanley, Credit Suisse, every single one of them will publish what is a country risk premium for example, Myanmar, Vietnam, Thailand, Philippines, etc., etc. Now, as you can imagine, each of these brokers will also have different estimates. So you just got to follow one broker, one, not keep switching, not switching. Yeah? Today I follow Goldman, next week I follow Morgan Stanley. It doesn't work that way. You just follow one broker all the way. Okay, so either you get it from Saint-Gobain internal research or you just follow the broker. Make it simple. Okay. Any questions? Oops, hang on. Any questions I can take on the WACC first, on the cost of debt and the cost of equity first, before I move on to the DCF concept? Okay, all good. So let me just touch very quickly on this slide. Simply put, we have surveyed 200 of our investment banking clients across different industries. And simply put, among different methodologies, our clients came up with 96% of them uses the DCF in their valuation method. And among this 96%, most of them believe that the DCF is the most important valuation metric versus other kinds of valuation methodologies out there. Let me just very briefly touch upon each of these different valuation methodologies. Yeah, DCF, we're going to talk a lot about it, so I'm not going to explain it now. Hurdle rate. Hurdle rate is basically your IRR analysis. Okay, your internal rate of return analysis. We did a simple example of that in webinar 1 on our Excel. So simply put, you have a hurdle rate for, say, Saint-Gobain, or maybe you may have a hurdle rate for each of your different divisions given by Saint-Gobain. If you want to have any new projects, let's just assume the hurdle rate is, say, 10%, for example. So in order for Gobain's investment committee to approve your project, you need to beat 10% IRR. It's very simple. So the hurdle rate, you show a higher number than 10%, you accept the project. You show a lower number than 10%, management is not going to accept this project. So that's hurdle rate. Comparable deals and trading multiples, we will talk more about that in webinar 4. All right, so not I'm going to talk too much about it now. Payback. Now, payback, simply put, class, what is key takeaway number 2? Key takeaway number 2, total return is equal to dividend yield plus capital gain. Similar to our Excel that we did on webinar number 1, you know that there are 2 cash flow streams, right? Dividend yield is much more recurring. It is more tangible. You can see it clearer because it comes every year. Whereas capital gain, as you can imagine, only comes in year 5 when you sell. It is a bit further away. You are not quite sure whether you can get it. It's, a little bit, I use the word, not so tangible. Not surprisingly, for you as an executive, you would like your money or your principal to come back as soon as possible, right? Versus later. You would like it to be a higher dividend yield and lesser capital gain, if you could. Now, depending on which industry you are in, okay, the faster payback will be good. The payback, simply put, is how many years do I need before I get back my principal? It's that simple. How many years do I need before I get back my principal? Unfortunately, for real estate businesses like Gobain, you are only going to get back your principal when you sell most of the time. If you don't exit, you don't sell, very hard to get back your principal amount. The next valuation method is EVA, economic value add. Economic value add is, it is a trademark by Sten Stewart. The new term of what we call it nowadays is what you call key takeaway number 3. Again, class, what is key takeaway number 3? Increased shareholder value is equal to ROIC minus WACC. ROIC minus WACC. Simply put, ROIC minus WACC greater than 0 is your EVA, economic value add. We don't really call it economic value add, as I said, because EVA was just trademarked by Sten Stewart, but the principles is the same, ROIC minus WACC. And we'll talk a lot more about ROIC minus WACC in the next slide. So I will touch upon that then. APV, adjusted present value. Adjusted present value is simply put, the present value of a levered firm is equal to the present value of an unlevered firm plus the present value of the interest tax sheets. We will talk more about this valuation concept in webinars 6 and 7. 6 and 7, when we talk about the capital structure. Simply put, you can take away, or if you think about it, it makes sense, right? The value of a levered firm is equal to the value of the unlevered firm plus the value of the present value of the interest tax sheets. And we'll talk more about it in webinar 6 and 7. Monte Carlo. Monte Carlo is very similar to what you call machine learning in today's context, data science, etc. Prior to the new age, they just gave it a nice name called Monte Carlo, but really this is called machine learning or black box. Now, what it does is there's a computer program algorithm. You put in as many data points as possible. Now, this is driven by 2 conditions. 1, the more data points, the better. And second, the higher the quality of the data points, the better as well. So your job is to provide the machine with a large number of high quality data points. Okay? Now, what the machine will then do is to force out a normal distribution curve. Okay? As you know, a normal distribution curve, as you have learned from your statistics class, is what happens mostly in everyday life. Most of the occurrences fall into a normal distribution kind of probability. So what the Monte Carlo algorithm does is to force out a normal distribution curve on your observations, giving you a mean and a standard deviation. So simply put, the more data points or more quality data points you give, the better it is for the program to spit out the output. Now, as you can imagine, all of these methodologies, they rely on one general principle, okay? And that is called GIGO. Anyone know what that means? GIGO? Okay, so GIGO simply means garbage in, garbage out. Okay, garbage in, garbage out. All these are tools. All these are valuation tools. They are dependent on the inputs that you put into the system. Simply put, you put in garbage inputs into the system, your output, no matter what you use, DCF, hurdle rate, etc., will obviously be garbage. So as financial managers, what you need to make sure are that your team gives you good quality inputs, okay? Good quality inputs. What we'll be learning during this webinars, series of webinars, is on how to use and interpret these tools in greater detail. But what you need to ask your team to do is to give you good quality inputs. And I will try to crystallize that concept again in greater detail as we move down the slides. Now, let's focus on the core valuation principle. This is very important. Now, simply put, our 7 webinars, they are based off this book called Value, V-A-L-U-E, Value, which is published by McKinsey. Please read the book if you can. It's currently in its 7th edition. It's been published in the last 20 years. And the 7th edition just came out this year, all right, 2020. Simply put, what McKinsey is saying is that there are 4 cornerstones of corporate finance. Cornerstone number 1 is the core valuation principle. In class, you have learned this before. What is key takeaway number 1? Core valuation principle is increase cash flow, increase asset value. Very good. We will talk more about core valuation principle number 1 in just a bit. So let me skip on to core valuation principle number 2 first. Core valuation, cornerstone number 2 is on conservation of value, which is basically talking about how much debt, how much equity should we use in our company, i.e. how should we slice the pie for optimum capital structure. We will be covering conservation of value during webinars 6 and 7 when we talk about debt. Cornerstone number 3 is on expectations treadmill. This talks more about how should companies react to short-term versus long-term investors. As you can imagine, there are short-term and long-term investors invested in Gobain, right? How should we react to short-term and long-term investors? We will not be covering cornerstone number 3, but for those of you who are keen, please read the book Value by McKinsey. Cornerstone number 4 is best owner principle. Best owner principle simply asks the question, are you the best owner of the business? Maybe it's time for you to sell this business to someone else who can extract more value from a business. In short, this is about M&A, mergers and acquisition. Again, we will not be covering M&A in this course, but likewise, for those of you who are keen to learn more about the best owner principle, please do read more on the book Value by McKinsey. Now, let me refocus back to cornerstone number 1, core valuation principle. And what does it mean? So the core valuation principle says that if investors and managers, if they have learned anything from the turbulence on the market and the economy in recent years, that there is no substitute for real value creation. What do you mean by real value creation? Simply put, if you look at the words in red here, value creation increases the firm's overall cash flow, which in turn leads to higher valuations. Now, this is important because it is irrespective of whatever valuation method you use. It doesn't matter whether you use DCF, EBA, Monte Carlo, trading multiples, doesn't matter whichever valuation method you use, so long as you increase the firm's overall cash flow, it will lead to higher valuations. Now, what drives cash flows are revenue growth and ROIC. Revenue growth and ROIC drives cash flows, which in turn drives valuation, not net profits. Now, financial engineering, excessive leverage, and the idea during inflated boom times that somehow the old rules of economics no longer apply. Now, these are the misconceptions upon which value of economies or companies are eroded and entire economies become inefficient. Now, we are going to take a quick look at this McKinsey video that shows in greater detail what is the core valuation principle. This is a very important video. Now, as we are watching this video, I do want you to take note of 3 questions. Okay, 3 questions. We will revisit these 3 questions again after the video, but you know, the presenter does it in a very good job. So please pay attention. The first question is, the presenter will show you how does ROIC minus WACC create value. Okay, ROIC minus WACC create value. There will be a 4x4 matrix with numbers showing how ROIC minus WACC creates value. Please pay attention to those numbers. Second, the presenter will then ask, is growth good for you? Should you grow? Okay, should you grow? And a related question to that is, if ROIC minus WACC is less than 0, we talked about this, ROIC minus WACC is less than 0, means you're destroying shareholder value, right? What can you do to fix it? What can you do to fix it? And the third question is, different corporate strategy has different implications for creating different amounts of value. So that the presenter will show what strategies create what kind of value. Please pay particular attention to that as well. That will tie, you know, very often you hear, how does corporate strategy tie in with finance, right? So that part will show you how does corporate strategy influence the financial decisions that you'll make. So as the presenter goes through the video, please take note of these 3 key points, and we will revisit some of these key points again after the video. Okay. Can everyone see the core value principle screen?
Yes.
Yes. Yes.
Okay, good. Let me know if there's if the video is functioning properly, yeah?
How do companies create value? That's the fundamental question behind all business decisions. You create value by growing revenues, by growing earnings. What are the things that you need to keep?
Sorry, we can't hear the voice.
Yeah.
Yes.
There is no voice.
Yeah, me too.
Oh, no audio?
Yeah, and the signal is interrupted.
Oh.
Last.
Okay, let me try again. Yeah, I'm gonna share first. Share content. See that I'm optimized. 1 second. Okay, I'm going to try one more time. Let me know if we are better this time.
Nothing.
No, it's not
No.
better.
No voice.
No audio?
No.
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 Okay. Okay. That is not quite what I expected. Oops.
Maybe you can share the link, Professor, so each of us can take a look on our own.
Sure. So the link is here, as you can see right at the bottom of the slide here. Okay, so if you paste on that link, copy and paste on the link into your web browser, you will basically come to here, and right at about in the middle of the screen, there should be like a video tutorial, and what you will need to listen to is the core valuation principle. This whole video is on the 4 cornerstones of corporate finance. It will take you about an hour, but the cornerstone number 1 would be the core valuation principle. Let me, well, this is not fun. Share. Okay, let me try sharing my Google. Last time, hopefully the video works. Let me know if it doesn't work. Yeah.
No, there is no sound.
Okay, no sound. Understand. Let's go the backup method then. Okay. Sorry. Wait. Okay, you can see the Microsoft Excel.
Yes.
Yes.
Okay. So the only way, okay, well, I would suggest that all of you please take a look at that video on your own time. But for now, let me just recap some of the key messages from that video. Okay. Now, simply put, about key takeaway number 3. What is key takeaway number 3? We learned that how do we increase shareholder value? If we increase shareholder value, here we increase shareholder value when ROIC minus WACC is greater than 0. Okay, so simply put, if ROIC minus WACC is greater than 0, we increase shareholder value. ROIC minus WACC is less than 0, we destroy shareholder value. And if ROIC minus WACC is equal to 0, we neither increase or destroy shareholder value. As you can imagine, the third case is more of a theoretical case. Most companies fall into either case number 1 or 2. You either increase or destroy shareholder value. In it, the presenter then asked the next question: should you grow? Or in this case, revenue growth. Okay. And simply put, if ROIC minus WACC is greater than 0, yes, you should grow. The numbers in the video will show that the faster you grow, the more value you create. It's quite similar in concept to our simple Excel on webinar 1. as we talked about it, if ROIC minus WACC is greater than 0, okay, likewise, the more leverage we take, the more values we generate. Your IRR and your ROE increases if ROIC minus WACC is greater than 0. So the idea is quite similar here. Likewise, if ROIC minus WACC is less than 0, okay, so remember on back last Monday when we doubled the interest rate to 6%, okay, our going in yield was 5, NOI yield was 5, but when we double our interest rate, it becomes 6%. We see that ROIC minus WACC is less than 0, and we also saw that the more leverage we took, the faster our IRR goes down, right? So likewise, if ROIC minus WACC is less than 0, we are destroying shareholder value, and we should not grow. No, we should not grow. The faster if we do grow, okay, then simply put, the faster we grow, the faster we destroy shareholder value. But here's the thing. Imagine if you were to tell your boss, we should not be growing because our ROIC minus WACC is less than 0. That's not going to be a easy conversation to have. That's going to be part of the negotiation module, all right? But how do you tell your boss bad news? Our ROIC minus WACC is less than 0. You should not grow. You might not have a job tomorrow, right? So this is a separate issue. But no, you should not grow, because the faster you grow, the faster you destroy shareholder value. And the last part here is if ROIC minus WACC is equal to 0, should you grow? You will say it doesn't matter. Okay, it doesn't matter. You can grow or you cannot grow. It doesn't matter. You neither increase nor destroy shareholder value. And a picture that he would give would be like, it would be as if like you're running on a treadmill. You run on a treadmill, you increase the speed, you run even faster, you get speed. By the end of the workout, you are still at the same position, no difference. But as I mentioned earlier, if ROIC minus WACC is equal to 0, this is more of a theoretical case. Most companies fall into either you increase shareholder value or you destroy shareholder value. So these two cases. Now, next question here. If ROIC minus WACC is less than 0, what should I do? How do I fix this problem? So, simply put, in most of your companies, you have a CEO. The CEO then is in charge of two people, right? Your COO and your CFO. Simply put, your COO is in charge of all your operating decisions. And simply put, he's in charge of ROIC. Your CFO is in charge of all the financial decisions. And is in charge of WACC. Now, let's look at your typical income statement to illustrate what this means. So let's go through a typical income statement. Let me just write it down first. Yes. Okay, good. So let's go through each of these. Hang on. This simple income statement. So what we have is your revenue, And we know revenue minus your cost of goods sold gives you gross profit. Gross profit minus your SG&A, which is your selling, general and admin expenses, otherwise known as operating expenses, bracket X your excluding depreciation and amortization, because this D&A often gets lumped into operating expenses. So we need to take out the D&A from your operating expenses. What you then get is your EBITDA. EBITDA less depreciation and amortization gets you to EBIT. EBIT less interest expense gets you to profit before tax. Profit before tax less taxes gets you to net profit. Now, in your simple income statement, you also know that your EBIT is otherwise known as operating profit, right? For a simple reason. Anything from revenue to EBIT, this is, let me color code it. This here belongs to your COO. It's otherwise known as operating decisions, otherwise drives what we call ROIC. And whatever happens below this line, below the EBIT line, really depends on how much equity and how much debt do you use. And this belongs to your CFO, which drives how much equity, how much debt do you use, which in turn drives the WACC. So let's look at each of these roles first. So for the COO, or the operating decisions, if your ROIC minus WACC is less than 0, and you're destroying shareholder value, what you should be asking your COO will be questions like, are my products distinctive enough? Are my cost structures too high? As well as, is my supply chain optimized? Just a few of those simple questions. These are all operating decisions. Now, just to be clear, you're asking these questions relative to my competitors. As you can imagine, your return on invested capital is highly dependent on which industry you're in. Okay, so Gobain, of course, in building construction, no point comparing Facebook or Snapchat, which is totally different business model altogether. So you should be asking your COO relative to my competitors in the building and construction industry. If my ROIC minus WACC is less than 0, I'm destroying shareholder value. Some questions I might ask is, are my products distinctive enough? Are my cost structures too high? And is my supply chain optimized relative to my industry competitors? Okay. Now, likewise, for your CFO, you might want to ask the same questions on WACC, i.e., is my capital structure optimized? Am I using the right amount of equity and debt relative to my competitors? Now, for this part of the question in green, we will answer it during webinars 6 and 7. That's when we talk about debt. For the rest of webinars 2, 3, 4, and 5, we'll be focusing on this part here, on the yellow part, on the ROIC. Okay, and of course, together, the ROIC minus WACC gives you whether or not to increase or decrease, destroy shareholder value. Simply put, if you don't have a COO or CFO, then you look towards this guy here, the CEO, for all the answers. He either has 2 people helping him, or he just takes on everything. All right. Now, the video then goes on to show what different corporate strategies does to impacts the amount of value you create. At the top of that list is new product introduction. New products, simply put, create an awful amount of value. And in short, that's why your handphone companies, Apple, Samsung, Huawei, every year they need to have new products, right? No matter what, even if it's just an incremental difference, there's always a new product because new products create an awful amount of value. right at the bottom of that chart as well, you will see that M&A, mergers and acquisition, create the least value. Okay, M&A create the least value. And that M&A creates the least value for two reasons. First, think of M&A as a very big investment. So simply put, you must buy low, sell high. But most M&A, unfortunately, takes place where? Closer to the top of the market cycle. For the reason, business outlook is good, financing is ample, and investment committee will be easier to approve the purchase. Unfortunately, valuations are expensive as well. That's one point. You are not buying cheap. The second simple answer to that is when you buy a business, you need to give a control premium. So you won't be buying at the market price. Otherwise, no one want to sell you, right? So you do need to pay a control premium. And depending on that control premium, that could determine the amount of value left over. Okay, because you pay or you overpay too much of a control premium, then there's not much value left. So right on that chart, right at the top is new product introduction. Right at the bottom will be M&A. Now, on the second top of the on the second one, that means below the new product introduction, the second most value creating strategy is to make consumers use your product more often. Okay, make your consumers use your product more often. Now that will resonate with particularly this year in times of COVID-19. It is not surprising that if you make hand soaps, consumers just wash their hands more often, and in return creates demand for your products. So not surprisingly, you will see that in this year, companies that make hand soaps, sanitizers, PPE, which is personal protective equipment, gloves, have been making an awful amount of profit because these are essentials, right? So again, if for some reason you can make consumers use your products more often, that'd be great. On the bottom of the chart as well, which is just above the M&A, is competing for market share in a stable market. Now, competing for market share in a stable market really entails price wars. So I lower my price in order to gain more market share. But price wars typically destroys value for everyone. Because I lower my price, as a competitor, what do? You won't sit there and do nothing, right? It's game theory. You lower your price as well, and then I lower mine again, you lower yours again, and very soon, it's going to be a downward spiral. So price wars often do not create value. They destroy value for all players in the industry. So trying to gain market share in a stable industry is not quite the best corporate strategy to do. So again, unfortunately, the video would have been very easy to show you in diagrams as well as numbers, and then you will have come to this takeaway after the video. Unfortunately, technology wasn't our side today. But any questions I can take on the core valuation principle first? All good? Okay. So just to re-emphasize our core valuation principle, two things. Class, what is key takeaway number one? Key takeaway number one, down here. Key takeaway number one, what is core valuation principle? Increase cash flows, increase asset value. And class, how do you increase shareholder value? What's key takeaway number three? ROIC minus WACC is greater than 0. Very good. As you can see, my 3 key takeaways are each less than 5 words. All right, each was less than 5 words. I'll be repeating them again and again throughout the next 7 webinars, so that if anything, if you forget about my entire course, I just want you to remember 3 key takeaways. That is the basis of this 7 webinars, in short. Okay. Now, let me move back to my slides. All of you can see the slides, right?
Yes. Yes.
Okay, that's good. Okay, so let me move forward to talk about DCF. So this is the stepwise principle, or stepwise recipe to create a DCF model. Step 1 is to define forecast period. In DCF, that typically you will see very often you see 5-year and 10-year DCFs. For purposes of our slides, I'm just going to call it a 10-year DCF. So for step 1, we're going to define a forecast period, i.e. we're going to forecast for the next 10 years. Number 2, we will then forecast the free cash flow for the next 10 years for the business, Gobain, for example. Third, we'll then estimate the WACC. Fourth, we'll estimate the continuing value. Now, step 4, please take particular note, and I'll repeat this again. Step 4, which is to estimate the continuing value, is really the key part if you want to manipulate the fair value of Gobain, or fair value of the company. True, there are subjective estimates at every step of the process, but step 4 is where, because it contributes most of the value, at least 60–70% of Gobain's value. If you want to manipulate fair value, you just play or manipulate step 4. Don't waste time on all the other small steps, right? And we'll talk more about step 4 when we get there. Step 5, you then discount the free cash flow and the continuing value at WACC to get the firm value. Step 6, you then add the market value of any non-operating assets to get the enterprise value. And lastly, we subtract net debt. What is net debt? Net debt is total debt minus total cash. Total debt minus total cash to get the fair value of equity, or what is the fair value price for Gobain stock. Okay. Now, let's look at how we calculate NOPLAT and free cash flows. These are 2 important terms, because NOPLAT drives ROIC and free cash flow drives your DCF. Okay, let me just take it from the top first. So first you have your sales less cost of goods sold minus SGA minus depreciation expense to get your EBIT, or your operating profit, as I mentioned earlier. Now for operating profit, you then need to adjust what is your cash taxes on EBIT, okay, to get your NOPLAT. Now NOPLAT is something new. I'll talk about cash taxes on EBIT first, just a while. But simply put, for NOPLAT, what is NOPLAT? NOPLAT is your net operating profit less adjusted taxes. The keyword here is adjusted taxes, which is your cash taxes on EBIT, and I will touch more upon this in just a second. Now, what is ROIC? Return on invested capital is equal to NOPLAT divided by invested capital. Okay, ROIC equals to NOPLAT divided by invested capital. Next, we then add depreciation expense, minus your increase in working capital, minus your capex to get your free cash flow. This free cash flow in red here, this fits to your DCF model, your free cash flow to equity. Okay. Now, if you recall your webinar 1, remember on Excel, I also said that the middle row, which is your NOI/FEFE, is most important. Whenever I say increase cash flow, increase asset value, this is really what I mean. Increase free cash flow to equity. So again, if you are valuing an asset, you improve the NOI, the net operating income. If you are valuing a company like Gobain, you need to improve the free cash flow to equity. This line here. As long as you increase cash flow, you will increase asset value. That's core valuation number one. Now, let me take a step back and talk a little bit more about what do you mean by cash taxes on EBIT. Now, very often you pay taxes on PBT, right? Profit before tax. Okay, profit before tax. So cash taxes on EBIT is more of a theoretical question, term. Basically, it asks, how much taxes do I pay if it were based out of EBIT? Now remember, EBIT is on top of profit before tax. EBIT is usually a larger number than your PBT, right? So in EBIT, typically you have to pay more tax if the tax authorities were charging you taxes based on EBIT. So what does this mean here? Minus taxes on EBIT. There are two tax systems in this world. Now the first is a flat rate, like Hong Kong. So simply put, this is easy. If you're in Hong Kong, it simply means you just take 17%, which is the corporate tax rate in Hong Kong, 17% multiplied by my EBIT. It's as simple as that. If you're paying taxes on your PBT, you just take 17% multiplied by PBT. Taxes on EBIT will be just 17% times EBIT. It's just one flat tax, 17% times whatever is your taxable income. Other countries are like Singapore. Singapore has a progressive income tax system which falls into different brackets. Simply put, because PBT, the profit before tax, is a smaller figure, it might fall into a lower tax bracket. Your operating profit, your EBIT, may be a higher number, and it may fall into a higher tax bracket. So in a progressive tax system like Singapore, you need to be very careful whether or not, or calculate what is your marginal increase in your tax rate when you are paying taxes of your EBIT instead of PBT. Okay. Next here is your deferred tax. What are deferred taxes? Simply put, this will be difference in your depreciation policy. So, for example, let's just say Gobain buys a laptop, and Gobain depreciates it in, say, 3 years. Okay, i.e., you think that the useful life for your laptop is 3 years. But the tax policy, and remember, each country, there are different tax policies, right? France, Thailand, Singapore, Vietnam, etc. So, for example, let's just say Singapore says, under the tax rules in Singapore, it says that you must depreciate your laptop in 1 year. Now, there is flexibility in your interpretation of your accounting rules versus, the tax rules. So what that means is on your IFRS, your accounting statements, yes, you are still allowed to keep the depreciation period as 3 years. But for purposes of paying to the tax authorities, you need to depreciate it over 1 year. What that would give rise to is a deferred tax asset or deferred tax liability. Simply put, either the tax authorities owe you money or you owe the tax authorities money because of your difference in your depreciation schedule. As you can imagine, after 3 years, that difference will zero out as well. Okay, after 3 years, the difference will zero out. But in between those 3 years, either the tax authorities owe you money or you owe the tax authorities money, which gives rise to either a deferred tax liability or the deferred tax asset. Simply put, these two items here, your taxes on EBIT and your increase in deferred taxes, are what is known as cash taxes on EBIT, and what changes your EBIT into your NOPLAT. Again, NOPLAT divided by invested capital is ROIC. Okay. Now, okay, yeah, let me last slide here first. Now, this is what an equity analyst did for a 10-year free cash flow forecast. Let me walk you through the analysis. So this equity analyst has looked at this company. These are actual numbers for the last 5 years. And he looked at the sales growth. So as you can see here, average sales growth for the last 5 years, approximately say 7%. And he also looked at what is the operating profit margin. Operating profit margin, he looked at it, actual numbers, approximately around 15% for the last 5 years. What this analyst has done is to extend and says, okay, this company for the next 10 years will grow at an average 7% revenue growth for the next 10 years. As you can see here. And this company will grow or maintain a 15% operating profit margin for the next 10 years. Okay. Now, whenever you see an analysis such as this, you tear this page up and you throw it away because it's useless. Okay. This is nonsensical forecasting for 2 reasons. Number one, you cannot just say, oh, look, I've grown at 7% for the last 5 years. I'll grow at 7% for the next 10 years. Businesses don't work this way. You need to break down the revenue into your revenue drivers. Okay, specific revenue drivers. You cannot, and I repeat again, you cannot drive it on a revenue growth number. It makes no sense whatsoever. Caveat first, caveat. We are talking about stabilized businesses such as Gobain. We will talk a little bit more about digital valuation, webinar 4. So that's when we will talk about what happens if the company doesn't make profits, so forth and so on. And when we talk about your IPO case study, Snapchat, that will flush out this conversation even more. But for purposes of our slides for now, let's just limit our conversations to say Gobain, which is a stabilized cash flow company, you know, not a startup, not a digital valuation, all right? So for stabilized cash flow companies such as Gobain, you never model it off a sales growth number. It makes absolutely no sense. You need to break it down into your revenue drivers. And you know, Gobain has different divisions, right? Different divisions. Each segment has different revenue drivers. It is not a one-size-fits-all. So you must break down each different segment into their revenue drivers. Next, operating profit margin. Same thing. You cannot look at the last 5 years and say, okay, the actual EBIT margin was 15%. Let's just drag it out and assume the next 10 years will be 15%. Makes no sense. What drives operating profit margin? It will be your competitive positioning within the industry value chain. How do you derive your competitive positioning? Again, please revisit your corporate strategy charts, modules, your notes from the course. There are many different industry frameworks. For example, Michael Porter's 5 Forces. There are also other kinds of similar industry frameworks. Any one of them works as long as you know how to do it. But the whole point is, you need to figure out the question, why do my customers buy from me and not someone else? Okay? Why do my customers buy from me and not someone else? Now, industry profit margin, as you can imagine, is also a game theory. Okay, it's a game theory thing. You are part of your industry. Whatever decision you make, your competitor will react to it. They won't just sit back and say, oh, okay, you know, let you earn the money, no problem, go ahead. They will do something about it. And when they do something about it, the industry dynamic changes as well. You will again take an action fight them on what they have done, right? And as you can imagine, this is an iterative process. It's very dynamic. It's game theory, so to speak. Now, by doing nothing, okay, by doing nothing, let's just say I'm happy where I am right now. The last 5 years, I've earned 15% profit margin, for example. These are actual numbers. If I sit on my hands and do nothing, the default position should actually be a declining margin, not a 15% margin to maintain. It will actually be a declining margin. You actually have to do something. Okay, you actually have to do something in order to even maintain your profit margins at 15%. What do you mean by do something? Again, please revisit your corporate strategy notes or course material on those frameworks down there. Okay. Now, your other balance sheet items, for example, depreciation as a percentage of sales, capex as a percentage of sales, working capital as a percentage of sales. Yes, you can model this up as a percentage of sales, i.e., the last 5 years of capex maybe around 8%. You can model this around 8%. So yes, you can work, for example, working capital as a percentage of sales, average roughly 33%. You can model this out as 33% or percentage of sales over the next 10 years. What you cannot do again is your sales growth, which you must break it down into your revenue drivers, as well as your operating profit margin, which you must think much more deeply about where your company or your operating segment is vis-a-vis your competitors. Okay? Now, in this simple one-pager forecast as well, you also notice two things. First is your NOPLAT, your net operating profit less adjusted taxes. And as you can see here, there is ROIC right at the bottom. Simply put, NOPLAT divided by your invested capital. Invested capital is basically debt plus equity. There's only two sources of capital. So debt plus equity is invested capital, and that gives you ROIC. Now, you also see this line here, free cash flow. Now, this free cash flow is important because it feeds into your DCF valuation. As I mentioned earlier, increased cash flow, increased asset value. Increased cash flow, increased asset value. This is what we are increasing. Free cash flow. This is the numbers down here. As long as we increase these numbers, it will increase valuation, no matter which valuation method we use. Okay? Now, we are going to stop here first. What we have done is we have defined a forecast period, i.e., we have defined a 10-year free cash flow, so a 10-year investment period. We have forecast free cash flow for those 10 years, and we have estimated the WACC. We will continue on part 4, which is continuing value, next Monday. But for now, any questions that I can take on whatever we have covered so far, anything on the WACC, on anything that we have covered today, any questions that I can take before we go on to the presentation by the reading team. Any questions I can take first? Okay, now if everyone's good, I believe we have the reading team number 1, consisting of 2 people. Let me just share the screen. You can, hang on. You can see the screen, right? So I believe we have reading value-based management of Joni as well as Inkason. So welcome to share your screen whenever you're ready, and take us through the whatever you've done for the reading. For the reading as well, can you please just share your slide in the a group chat? I believe we have a kind of like a folder where we can share all the information. So please put your reading presentation in there. So the screen is yours whenever you are ready.
The group chat. Professor, I understand that we are doing this exercise individually.
Well, let me just repeat again for the sake of everyone. So if you look at your course outline, these are in teams. So, Inkason and Joni will be grouping together as one team. You will need, so for today, you need to present value-based management. And you will also be for the same case team, number one, where two of you will work together. The course assessment will be, for reading presentation is 20%. For your case study presentation, it's 50%. And for class participation is 30%. So I hope that clears it up. Your reading one is a team effort. So yeah.
Well, so sorry, because I was taking this as an individual task, so I make by my own. I'm not working on prayer.
No,
I think
no
that's
worries.
also the.
Okay, so I'll tell you what we do. So why don't you go first, Joni, you go first, and then Inkason can go next. All right, so remember,
Professor,
5 minutes only. Yeah.
sorry, I misunderstand. I thought that we are going to take the detail of the case study today and we present next time. So I didn't prepare anything.
Okay.
So I take.
Okay. So Joni, did you prepare something?
Yes. Can you see my screen now?
Yes, I can see your screen. So I'll tell you what. So Joni, you take us through this today, and maybe Inkason, you just prepare something, and we'll see if we can see your presentation next Monday.
Okay.
Again, the key points for what you need: 5 minutes maximum. One slide. You should, in those 5 minutes, you need to assume that everyone has read the article. Yeah, the 5 minutes is not meant to summarize the article. That's not the point. Out of the 5 minutes, you only summarize the article for 1 minute, i.e. the key takeaways, because you're assuming everyone has read it. You then spend 2 minutes talking about how this article can help your business in your specific area, and perhaps another 2 minutes how this article can help send Gobain in the broader context. Of course, those 4 minutes are fungible. It's up to you where you think you add most value, but it is more application rather than what the article is about, not just a summary. Okay, so I hope that clears what is needed for the article presentation. And Joni, you can give us the example of how it's done.
Okay, I will start, Professor. So the first slide is about the key takeaway from the readings. Right down here, the 3 common pitfalls of value-based management implementation. The first one is there are missing link between measurement and value, such as we are too focused on economic return measurement, but not on the future value creation. The example on the reading was we are doing price increment. Yes, in short, you can get economic return very fast, but for longer term perspective, you could lose your market share by only increasing price. The second point on the common pitfall of VBM implementation was wrong performance target setting process. In the process, the involvement are the key. The ownership and the commitments is coming from deep understanding of how the target are set. So it's better that when we are setting a target, it's not only top-down process, but we also include, I would say, discussion with those lower level of employee. The third one was a not tying performance evaluation and compensation to individual objectives. For example, if we are talking about profit, it should be in the individual objective, or also for business unit manager that link or tie to the performance evaluation of the business unit manager itself, and so on. The second slide is about what can be done for me, myself, on my today work as an employee of Saint-Gobain. I was working as a head of product management in Saint-Gobain, Indonesia. So first, I think what can be done is first to talk to my team, how important for us to deliver value to the company, and why and how. Second is to talk to my manager, how me and my team want to deliver the value. What sort of action we can do to deliver the value. Then I think we can start to draw a performance metric that deliver value. For example, for me and my team, the launch timing, how long each of product launch could take, what is the gross margin, etc. And also, if possible, to link the team and individual product manager performance to this performance metric. I mean the performance indicator. And the third one, to initiate as soon as possible an initiative to deliver value. For example, we can do product revamping or product repositioning, or we think about new product innovation. And the last slide is what can be done for Saint-Gobain. I suggest this 4 points for Saint-Gobain. First is to review on the strategy. For example, which segment or which region or which category need to be in our in Saint-Gobain focus, and how or for example, how to find better synergies between a business unit. We understand that Saint-Gobain has a lot of different business units, and maybe each other can synergize it. The second point was to evaluate all the performance metric, both in financial and operating. Does it represent the main value driver? And after this evaluation, we need to build the focus on the most important ones. The third point was identify and implement way of linking compensation with the main value driver achievement that can be contributed by each individual for all job level. And the fourth point, the last point here, is to make a different dashboard tailored to each smallest department in order for everybody to monitor and evaluate themselves whether they are delivering or not. I think that's all from my side, Professor.
Thank you very much, Johnny. That was very, very well done. So Johnny has, raised the kickoff and show us the bar, of how the 5 minutes can be used. Any questions for Johnny? Well, I guess, Johnny, please do share that, your work in the folder, the group folder. And I guess if any questions, you can always ask Johnny on, what his thoughts were when he read that article. Before I end off today's webinar session, any questions I can take on whatever we have covered today? Any questions at all? Case studies, readings, etc. Anything at all?
Professor, I couldn't find the chat section in my Teams. I don't know why. Maybe later I will send an email to all of them.
Yeah, I think in the Teams, if you look at the Teams, well, the Teams, there's two. One is you use a web browser or using an app. So if you download the app, which is easier, so if you download the app, there will be like the Teams Well, there'll be certain, let me see whether I can share my screen. Hang on. Okay, so can all of you see this?
Not
Yes.
yet. It's coming.
Here, do you see the Teams?
Yes.
Yeah, so simply put, I downloaded the app. So in the app, for example, if you look here, there's the Teams. This is the schema Teams, and I think you can upload class materials here, or files, or either one of these. Yeah, well, see, for example, you see the course pack is in here. Okay, so I believe you can upload your different files to this kind of like a class folder, you can call it, for the Schema Corporate Finance class folder. So we can use this as a example to share. So that's what I see. I'm also first time using Teams in a more professional setting. Usually I use Zoom. So well, either way, Schema has asked me to use Teams. So I'm also trying to learn as much as I can. One thing I did learn about Teams is that there's no audio when I'm sharing my files. So I've got to check that out. I'll apologize for it, try to fix it, and see whether we can get it working for next webinar. Okay, but yeah, please download the Teams app for your desktop.
Yes, now I understand. I'm logging with the corporate Gobain email. I should log in with the Schema in order to see this channel, the Schema Corporate Finance. I will do it later, Professor.
Okay. Any last questions before I dismiss the class? Okay, if not, thank you very much for joining me today. And I will see you for webinar number 3 next Monday at 3 p.m. And remember, there'll be 2 reading teams which will need to present, all right? So please prepare in your groups for those 2 reading presentations.
Okay.
Right? Thank you very much, and see you next Monday.
Thank you.
Thank you.
Thank you.
Thank you.
Bye.
Bye bye.
Bye.